Welcome to Starting Your Own Business Tax Considerations, presented by Meyer and Associates, Counselors at Law, PLLC. The first thing we have to tell you is that this presentation is designed to give general information about the topic and does not constitute legal, financial, or accounting advice. Your particular situation may differ than the general rule. Therefore, before taking any action, it is recommended that you speak with an attorney, accountant, and/or investment professional. This presentation does not create an attorney-client relationship. My name is Bruce Meyer. I am an attorney and certified public accountant. I've been in practice for over 35 years. I am the managing member of Meyer and Associates, Counselors at Law, PLLC, and I have a personal financial specialist designation awarded by the AICPA, American Institute of Certified Public Accountants. When you're starting a business, there are a couple of considerations that you want to take into effect. First of all, you want to minimize your personal liability, your personal legal liability as much as possible. You do not want to be at risk for your assets for losses or business debts. You would also like to minimize the tax consequences to your business, get the maximum tax benefits that are available. And these are the two considerations, and we're going to be concentrating on the tax consequences of your business. Basically, when you start a business, there are two types to consider. A pass-through entity, which consists of a sole proprietorship for one person, a general partnership for two or more. You can form a limited liability company with one or more people, and a subchapter S corporation. These are pass-through entities. You can also have a non-pass-through entity such as a C corporation, C being Article C of the Internal Revenue Code. When you're operating a business, when you're owning a business, you really have a few goals that are obvious. You want to maximize your real income, the real growth and the real money that you're generating, but of that real income, you want to minimize the taxable income and maximize tax benefits. And you want to be able to use losses that occur in the first few years on your personal tax returns. There is very little difference from a tax point of view between any unincorporated business, a sole proprietor, general partnership, or limited liability company, and a subchapter S corporation. For tax purposes, there is very little difference. There are some technical differences between them, but in all, you have no real change. The advantage of a pass-through entity is that you're not going to have double taxation. The pass-through entity does not pay tax on its profits and does not have its own losses. These losses and profits are passed through to the owners based upon their percentage of ownership in the equity or under some other arrangement depending upon what is legal. However, to deduct a loss, you must have basis, some investment or risk in the business to be able to deduct the losses under the Internal Revenue Code. When you form a business, and if you're doing this as a one-person business, a single-member business, if you want to avoid liability, and therefore you want to consider an LLC or a subchapter S corporation, you have to be aware that for liability points of view, they are basically the same protection. There is no personal liability for business debts unless you have signed personally. However, it is more expensive to form an LLC in the state of New York because New York law requires that all LLCs, single-member and multi-member LLCs, must publish, and therefore this cost of publication is high, especially in New York City and the surrounding areas. Subchapter S corporations do not have this publication requirement. However, a single-member LLC is less expensive to operate from a tax reporting point of view than a single-member subchapter S corporation, especially if there's no other employees. When you form a business, you have to be aware of the tax consequences, obviously. If you have an unincorporated business, such as a sole proprietor, general partnership, or LLC, limited liability company, the owners will pay self-employment tax on your share of the profits. Self-employment tax is basically Social Security and Medicare tax, the employer and the employee share. So you're pretty much paying the double of what an employee pays. You're paying the employer's share and the employee. Now, this rule applies to operating businesses, businesses that run a business, not real estate entities. As of right now, real estate entities' profits do not pay self-employment tax. One thing to consider, Social Security system needs money, and this is one thing that's being looked at to possibly raise more money for the Social Security system. Subchapter S profits are not subject to self-employment tax. So this is one thing that people look at. Now, a Subchapter S corporation must pay a salary to the owners who are providing the services. This salary is a salary to anybody else, is going to be subject to all payroll taxes, including Social Security, Medicare, you have to New York State disability insurance, workman's compensation insurance, federal unemployment insurance, New York State unemployment insurance. It is a salary, as if you were paying it to an unrelated individual. But if you have a corporation, Subchapter S corporation, and you are working it and the owners are actively involved in it, they must pay a salary. Therefore, a profitable Subchapter S corporation must pay payroll, it must file payroll tax returns, and it must file corporation tax return. If it was a single member LLC, it would not have payroll, it would not have to therefore file payroll returns. As we'll see, they do not file corporation tax returns. It is taxed as Schedule C. Therefore, a popular tax loophole, so people think, is to have all the profits of a Subchapter S corporation paid out as a distribution or dividend, and no salary being paid to the owners or officers. This would avoid all payroll taxes, Social Security, Medicare, etc., and would save the individual money as well as reporting effort. However, failure to pay the working owner of a profitable company a reasonable salary is going to result in an audit that is going to be unwinnable. The state insurance funds are going to need money as unemployment insurance is draining their coffers. They will come after you if you're not paying an amount equal to at least the unemployment insurance maximum. The federal government is going after people, and they have already sued people in tax court for not paying the proper, reasonable salary for the work that is being performed. A single-member LLC, therefore, is a very attractive alternative. If you have no other employees, no payroll tax return is required. There is no separate business tax return, as a single-member LLC is considered a disregarded entity. The business profit or loss is reported on the owner's, the individual's personal income tax return on Schedule C. If it was a real estate entity, it would be reported on Schedule E, Part 1 for running the operation. However, with this benefit, if you will, of not having separate returns, there is a downside. Income tax returns, personal income tax returns, 1040s, with a form Schedule C on it, have the highest rate of audit by the Internal Revenue Service of any type of tax return. So you're trading off the ease of not having separate tax returns to leaving yourself to a greater risk of having your tax return audited by the IRS. That's just something to consider. C corporations are a separate entity. It's a separate tax entity as well as being a separate legal entity. These are generally companies, you can imagine, like Ford, General Motors, IBM, and they pay their own taxes on their profits, and they keep their own losses, and they accrue them if they have losses. As far as a small business, most small businesses do not elect to be a C corporation. They may be stuck there if they do not make a proper S corporation election, but generally a small business should be an S corporation. However, you never say never, never say always. If the business is going to be reinvesting all of its profits and not making distributions, then a C corporation may be a viable alternative. So you have to look at the individual situation. Finally, an advantage of a C corporation is that you have the option of choosing its own year-end month. Pass-through entities, sole proprietors, LLCs, subchapter S corporations must have a December 31st year-end unless there's a compelling reason and you get approval from the Internal Revenue Service. So you have a little more flexibility with a C corporation and the year-end. Hope you've received some information and you've gotten some guidance. If you have any questions, please feel free to contact us, Meyer & Associates, Counsels at Law. Our offices are in Hauppauge, New York. You can reach us at 631-434-7633. Please visit our website at www.meyeresk.com. And you can reach me, Bruce Meyer, at bmeyer@meyeresk.com. We hope you've enjoyed it. Thank you very much for listening.